June 23rd, 2023, and wow, is it exciting to reconnect with veteran in these markets, Mr. Robert Prechter. Of course, everyone will know the name associated with Elliott Wave, at the forefront of Elliott Wave technical analysis and all of the science behind those impulses. They must read, really, the hallmark book. And then he has now Conquer the Crash, a more recent tome that he has published. So we're going to let him get into all of that neat stuff. Hello, Robert.
Hey, thanks for having me on. It's always good to be talking with a sharp guy who knows his subject.
Oh, you're too kind. And you know, Robert, we were talking before the show. I used to live just down the highway from your office, and now your offices have been telecommuted, and it's just a renaissance, I think.
Well, we found out that people loved working from home. I got my IT department to make sure everybody could work from home back in February of the COVID year. And by March, everyone was at home working. And a few months later, I thought, well, gee, maybe they're really missing going to the office and talking to their colleagues. So I emailed them all, and I got an 85% very strong response saying, no, we love working from home. Please don't change it. And they also said they thought they were more productive and even more connected because people were doing a Zoom call every morning. We had a big change, and we've got virtually everyone working from home now. They seem to love it. We have shrunk our office by about 85%. So that's a nice cost savings, and we've got a nice little facility for people when they want to meet.
Ironically, I taught a humble class there as just an adjunct. One of the interesting things that we found out in the management text is that they've shown recently that people are significantly more productive if and when they work from home. So you may have caught the trend again early. So why don't we just start today with the general markets? You know, we've had this big relief rally, or rebound, if you will, from a very difficult couple of years following the pandemic. Do you see new highs ahead, or what is your work telling you here?
The stock market has been in a relentless uptrend for a very long time. Some people date it to 2009, and that's perfectly fine. We date it to 2009, but we also date it back to 1974. We date it back to 1932, and you can date it back all the way to the founding of the country, which has been mostly a long-term uptrend. However, what happened in recent decades that very few people understand is that in real money terms, the stock market topped out in 1999. That's a long time ago, 24 years ago. So stock prices in terms of gold topped way back then. So we've been floating up higher in nominal terms, thanks to a lot of growth of credit and growth of underlying money supply by the Fed to the tune of $9 trillion. So it's really a fake money situation. Now, a lot of people think, okay, that's going to lead to hyperinflation and they're going to keep doing this. But my thesis is very different. I think because most of the dollar-denominated so-called money out there is really debt, and debt is in trouble, serious trouble. So I think a lot of what people consider money and debt-based purchasing power is going to just melt away. We saw just today, we've been talking about this for almost a year, the problem with commercial real estate. Now, it's one thing to have commercial real estate, not filling its buildings. If people simply owned the buildings, that would be a problem for them. But it's a much bigger problem than that, because most people who run buildings don't own their own buildings. They're either owned by investors or they're pledged to creditors. And we're finding that so many commercial buildings are just masses of debt. They've borrowed, say, $1 billion to keep the building going, and now they're finding they can't pay the interest on the debt, and they're considering walking away. If they do that, that's going to be a defaulted debt. So somebody who thought he had $1 billion worth of value is going to find out he has much less than that. And that is a threat of deflation. We've even got some deflationary activity in the Fed, which we can talk about as well. But for all those reasons, on the so-called fundamental side, I think the stock market is very precarious. But you know where the most excitement is? It's on the technical side, and we can talk about that if you like.
Yes, the technical side of the stock market. And precarious was not exactly what I expected to hear, but a lot of your colleagues in this realm are starting to point in that direction. Please tell us more about the tech.
Back in 2021, we were seeing we keep a lot of indicators. Momentum indicators, which are too popular for my taste, we keep very few of. But sentiment indicators are very, very important. They tell you not only whether people are optimistic versus pessimistic, but they can tell you the extent to which they are extremely optimistic or pessimistic. Well, 2021 was a year like no other. And finally, in December of 2021, I put out an issue called A Stock Market Top for the Ages. And I knew we were close. I didn't realize that would be the month in between the broad market top of November 2021 and the blue chip top of January 2022. But that's what happened. And I showed over 24 sentiment indicators that we had featured during the year of 2021. And I'll give you the flavor with just one of them. In the past, say from 2001 through about 2012, an indicator of how bullish or bearish people were was generally at a 2-to-1 ratio. And I'm talking here about the ratio of money in bullish funds versus bearish funds at Ridex. Ridex is a family of funds. And people can invest on the long side. They can also invest in funds that are short. And in the past, when they got to about 2-to-1, on the plus side, it was considered, well, that's lopsided optimism. They have twice as much money in long funds as short funds. Well, in 2021, the ratio didn't just go to 2-to-1 or 4-to-1 or even 8-to-1. It went all the way to 60-to-1. There was 60 times the money on the long side as there was in the short side. And that's only on the non-leveraged funds within Ridex. In the leveraged funds, where you can really gamble on the upside versus the downside, there was 80 times as much money on the long side as the short. It was so far out of the solar system, it was beyond Pluto. And we were stunned. And we said, there's never been a mania this intense in history. I mean, tulips were nothing. 1929 was nothing. 2021 was a period of absolute insanity. And we have 27 indicators I might have shown in that issue, all giving those kinds of flashing. Bells ringing at the top is what we were calling them.
Bells ringing, that conjures up images of the holidays, but these types of bells, it's more like for whom the bell tolls, I think, and that's investors. So you're looking and thinking from a very contrary perspective, at least, from mainstream Wall Street. And if you had to look into the forward-looking AI model, what do you see ahead for the markets?
Well, AI is an interesting term to bring up because it seems to be the focus of the latest mania. But think about it. AI is a narrow portion of the entire tech area. And tech is a narrow portion of the entire stock market area. And we had a mania in tech, which finally topped out in November 2021, right? And the latest rally has been in very few tech stocks. I think it's 8 or 9, no more than 10 tech stocks have accounted for virtually the entire gain in the S&P this year. The other 490 stocks in the S&P 500 are down or flat. That's an amazingly narrow market. And in the last couple of weeks, everybody's been talking about AI, which is a narrow portion of the narrow leadership. So it's almost down to, just very, very few stocks that were leading the latest rally. Meanwhile, the Russell 2000 index, which is not an index of 30 Dow stocks or 50 stocks or 100 stocks. It's 2,000 stocks. And this index has just been like a lead balloon sitting on the floor of the ocean, absolutely not rebounding with these other things. When you have a very thin market with, blue chips or some segment leading the way, it's a very bearish situation. And I remember back in the fall of 1973, from August through October of 1973, the blue chips, back then they called them the Nifty 50, were leading a very furious rally that did not carry to a new high. But the advanced decline line went sideways during that time, and the result was a 40% collapse over the following year in the stock market. And we've got the same kind of activity here. So that's a momentum indicator. So you throw the momentum indicator giving you bearish signals on top of the sentiment indicators giving you bearish signals.
Can you Outline any other sectors that I may have missed. I know you like to keep an eye on cryptos. And of course, you know what keeps the lights on here, the precious metals.
I think the other area that's in the most massive trouble is corporate bonds, especially junk bonds. We've been in a recent period when they were given get out of jail free cards with interest rates near zero, and people could just re-leverage and re-leverage and re-leverage. And that era is coming to an end. The creditors are going to start asking for their money. And I don't think, especially if the stock market goes down, that all of these corporate debts can be paid. So that's an extremely risky area. As far as cryptos go, I think we were the first newsletter to publish about Bitcoin when it was selling for 6 cents. My son was into Bitcoin in very early times, and he wrote a 2-page special report for my Elliott Wave Theorist publication. And we showed all the reasons why we thought, this was real. And it could replace currencies, and it had a huge future. We had no clue that it was going to go from 1 penny to $70,000 per coin, but we were very positive on it. But we had changed. Once it turned into an investment mania, we said, this is unsustainable. We still think it is. I don't think the bear market in any of these coins is over. It's rebounding right now, sort of like the stock market has been, but I think the long-term trend is down. And it even has a fundamental problem, which is the blockchain. It doesn't seem to be able to handle transactions at an extremely high level of popularity for the coin. So if somebody invents a better one that doesn't have that issue, that would put the value of Bitcoin at serious risk in my mind. And I hate to disappoint you. I'm going to say some very positive things about the metal, but I'm going to conclude that I really am not sure which way their prices are going to go. And that is because I do see this huge risk of deflation. Gold has already done a absolutely superb right-on job of reflecting the decline in value of the dollar since the founding of the Fed. Back then, gold was $21 an ounce, and it almost got to $2,100 an ounce in recent years. And that's exactly how far the purchasing power of the dollar has fallen, approximately 98.5% to 99%. So gold has done its job beautifully. And I'm afraid if we do go into, I'm not afraid, but if we do go into deflation, gold may not go to $10,000 an ounce, like a lot of people are saying. I'm not sure about silver. I recently wrote it up as one of the cheapest investments in the world. It's the only one I know of that's selling for half. In fact, right now it's slightly less than half of where it was selling in 1980. However, it's mostly an industrial metal now. And again, I'm not going to go out on a limb and trying to forecast these things. But the main thing I'd like to leave your readers with is what I said in my book, Conquer the Crash, which is everyone should have a stash of gold because it's real money. And in case of a worst case monetary collapse scenario, you should definitely have a few bags of silver coins. U.S. silver coins are sometimes called junk silver, but people recognize them and they could end up being a medium of exchange. In my book, I cover several things that I think are really important because I think we're going to go into some social unrest as well. So I've got instructions if you're interested in getting a second passport, if you're interested in storing your precious metals in a very safe place outside the country with very reasonable storage fees, you can come to our Conquer the Crash webpage. And we've got a link to that for anyone who's read that book. And, we've got some other things as well, like where's the safest or one of the safest banks offshore that you can get. So we've got a lot of things in that book that I think are helpful to the kind of people that listen to GoldSeek's Radio.
I appreciate and applaud your transparency. That's what we're looking for here. We're looking for veracity. And that's what the people keep coming back for and appreciate. Conquer the Crash. Robert Prechter, we want to wish you a very happy 2023 and a big hat tip for all that you're doing, sir.
Chris, it's been a pleasure as always, and you always get right to the point and wrap it up in a very efficient manner. So keep going. You're doing great. Thanks.